Your money-making broadcast starts now. Welcome back, everyone. It's Friday, May 9th, 2026, and Wall Street just wrapped up a session that felt like a mirror image of yesterday, with an even stronger tech tilt. The S&P 500 finished up 0.83% at 737.62, a solid close for the broad index. But look beneath the surface and you'll find a market that is anything but uniform. The Nasdaq 100 surged 2.34% to 711.23, powered by a second consecutive day of semiconductor fireworks. The Dow Jones barely budged at plus 0.04%, and the Russell 2000 chipped in a modest 0.68% gain. The VIX crept up to 17.19, a reminder that despite the rally, volatility hasn't fully left the building. Today's story is not the market as a whole, it's the chasm between technology and everything else. Tech stocks gained 3.44%, while financials, energy, industrials, and healthcare all closed in negative territory. That divergence is worth your attention because it tells us exactly where institutional money is flowing right now. We are going to break down the semiconductor supercycle that has Micron, Intel, and AMD on absolute fire. We will examine why healthcare is getting hammered even as the broader market rallies. We will talk about the Iran peace deal that is crushing oil prices and what that means for energy investors. And we will give you 4 specific stock picks that fit different investment styles for the weeks ahead. Let's get into it. Let's start with the biggest story of the day, and frankly, the biggest story of the week. The semiconductor sector is in the middle of what looks like a genuine supercycle. Micron Technology exploded 15.49% today. That is not a typo. Memory chips are experiencing a demand surge that analysts are calling generational. The buildup of AI data centers requires massive amounts of high-bandwidth memory, and Micron is the dominant player in that space. Intel surged another 13.96%, a second consecutive day of double-digit gains. Intel's foundry business is gaining traction, and the market is pricing in a genuine turnaround story. Advanced micro devices jumped 11.44%, riding a wave of GPU demand that shows no signs of slowing. Now, here's the critical thing, and I want to be very clear about this. We are not recommending you buy any of these 3 stocks at these levels. Micron is up 15% in a single session. Intel has gained nearly 30% in 2 days. AMD is up over 11%. When stocks surge this hard this fast, chasing is the fastest way to give back profits. In fact, AMD triggered a sell signal in our system today, complete profit taking at 25% gain from entry with RSI overbought at 77. We are taking money off the table, not putting more in. The semiconductor rally is real and the thesis is sound, but discipline matters more than FOMO. Now let's talk about a signal from the materials sector. Freeport-McMoRan triggered a sell_half signal today. The stock is up 6.1% from entry with RSI hitting overbought at 82. Copper and mining stocks have had a great run, but when RSI crosses 80, it is historically a time to lock in at least half your position. This is not a call on the long-term copper thesis. Electrification and AI data center build-out will demand enormous quantities of copper. But at these valuation extremes, prudent portfolio management means taking partial profits. The second major narrative today is the divergence between tech and everything else. The Technology Select Sector SPDR Fund, XLK, gained 3.44%. Meanwhile, financials via XLF dropped 0.6%. Energy via XLE fell 0.45%. Industrials via XLI lost 0.46%. And healthcare via XLV was the worst performer of the day, down 0.85%. This is a classic rotational pattern. Money is flowing out of cyclical, value-oriented sectors and into high-growth technology names. Why? 2 reasons. First, the ADP private employment report for April showed 109,000 jobs added, a number that is solid but not hot enough to change the Federal Reserve's rate trajectory. That means the rate environment remains accommodative for growth stocks. Second, the AI infrastructure build-out is creating a genuine demand shock for semiconductors, networking equipment, and cloud services. Companies cannot build data centers fast enough. The beneficiaries of that trend are overwhelmingly in technology. When you see financials and energy weakening while tech surges, it tells you the market is prioritizing earnings growth over valuation today. Let's turn to a sector that is causing concern for many investors, healthcare. Pfizer hit new lows today, falling 3.02% to 25.68. The stock is now trading at levels not seen in years. Eli Lilly also dropped 2.72%. The healthcare sector as a whole was the weakest link in today's market. The question on every value investor's mind is whether this is a buying opportunity or a value trap. Pfizer currently offers a dividend yield above 6%. The company has a massive pipeline and the cash flow to support that dividend. But the market is clearly worried about patent cliffs, pricing pressure, and the lack of a blockbuster catalyst in the near term. We are going to address this directly in our stock picks section because this is exactly the kind of situation that the legendary value investor, Benjamin Graham, built his entire philosophy around, buying quality assets when they are out of favor and trading below intrinsic value. Speaking of out-of-favor sectors, let's talk about energy. Oil prices are dropping on news of progress in US-Iran peace negotiations. The Trump administration is pushing for a ceasefire deal with Iran, and markets are pricing in the possibility of Iranian oil returning to global markets. That would increase supply at a time when demand growth is already moderating. The Energy Select Sector SPDR Fund, XLE, fell 0.45% today. This is a geopolitically driven move, not a fundamental deterioration in energy companies. If the Iran deal goes through, we could see a near-term supply glut that pressures oil prices further. But for long-term energy investors, this creates a potential entry point if you believe the structural thesis for energy remains intact. Cybersecurity had a standout day. Palo Alto Networks surged 5.78%. Enterprise security spending is accelerating as companies upgrade their cyber defenses in response to an increasingly complex threat landscape. AI is creating both new security challenges and new security solutions, and Palo Alto is at the center of that transformation. When you see a stock like PANW moving 5% on a Friday, it tells you institutional investors are positioning for a major theme in the quarters ahead. Now let's move to our 4 stock picks. These are actionable ideas designed for different investment styles and time horizons. Number 1 is Cisco Systems, trading at 96.57 after gaining 4.8% today. Cisco is the networking backbone of the internet. Every company uses Cisco equipment. The AI data center build-out requires massive investments in networking infrastructure, switches, routers, and optical interconnects. Cisco is the primary beneficiary of that trend. We are looking at this through the lens of the legendary balanced investor, Peter Lynch. Lynch famously said to invest in what you know, and Cisco is the definition of a company that is easy to understand. Every time a company builds a data center, Cisco sells networking gear. The thesis is straightforward, the balance sheet is strong, and the dividend is growing. This is a buy for investors with a 6 to 12-month time horizon. Number 2 is Oracle Corporation at 195.95, up 0.7% today in a mixed session. Oracle is in the middle of a massive cloud transformation. The company has database monopoly power. Most of the world's critical enterprise data lives in Oracle databases. The legendary growth investor, Phil Fisher, would have appreciated Oracle's strategy here. Fisher looked for companies with superior research and development programs and strong sales organizations. Oracle has both. The company is investing aggressively in its cloud infrastructure, and early signs suggest those investments are paying off. The stock is not cheap, but for growth-oriented investors with a long-term view, Oracle offers a compelling risk-reward profile. Number 3 is Pfizer at 25.68, down 3% to new lows. This is a classic value play. The legendary value investor, he, taught us that the best time to buy a quality company is when it is temporarily out of favor. Pfizer has a 6% dividend yield, a diversified pipeline, and the financial strength to weather the current headwinds. The key question is whether the company can deliver a pipeline catalyst in the next 12 months. If it can, the upside from these levels is substantial. If it cannot, the dividend provides a floor. For patient, value-oriented investors, Pfizer at $25 is worth a hard look. Just be prepared for volatility. Number 4 is Roku at 129.53, up 2.3% today. Roku is the dominant streaming platform in the United States. The innovation investor, Cathie Wood, would argue that Roku is at the intersection of multiple disruptive trends: cord cutting, connected TV advertising, and the shift of ad dollars from linear television to streaming. Roku's ad revenue is growing as more advertisers recognize that streaming audiences are where consumer attention is migrating. The company is not yet consistently profitable, but its platform scale gives it a significant competitive advantage. For investors comfortable with innovation-stage companies and higher volatility, Roku offers exposure to the secular shift in how we consume media. Let me briefly touch on a few other movers worth noting. Palo Alto Networks we already covered. Constellation Energy, ticker CEG, has been gaining attention for AI data center power demand. That is a narrative worth watching. Coinbase and Bitcoin-related plays have been active with Bitcoin at its highest since January. And enterprise software names like Salesforce were weak today, down 2.43%, suggesting some rotation within technology itself, money moving towards semiconductors and infrastructure and away from software applications. One final note on the macroeconomic picture. The ADP employment number of 109,000 private sector jobs added in April is consistent with a labor market that is cooling but not collapsing. The Fed is likely to remain on hold for now, which is supportive of risk assets. The Iran peace negotiations add a wild card on the geopolitical front. A deal that stabilizes the Middle East and brings Iranian oil back online would be broadly positive for global markets, though painful for energy stocks in the near term. To summarize the key takeaways from today's session. The semiconductor supercycle is real but extended. Take profits, do not chase. Tech is dominating while everything else struggles. Healthcare offers a potential value opportunity but requires patience. Iran peace is reshaping the energy landscape. And cybersecurity spending is accelerating. For stock picks for your consideration, Cisco for balanced investors, Oracle for growth investors, Pfizer for value investors, and Roku for innovation-focused investors. Do your own research, size your positions appropriately, and remember that the best investment strategy is the one you can stick with through the volatility. That wraps up our coverage for Friday, May 9th. A fascinating session dominated by semiconductors, a stark tech versus everything divide, and growing geopolitical crosscurrents around oil and the Middle East. The key lesson from today is that markets reward discipline. When a sector rallies 15% in one day, the smart move is to take profits, not pile on. When a quality company hits new lows with a 6% dividend yield, the smart move is to investigate, not panic. Build your portfolio around businesses you understand, at prices that give you a margin of safety, and with time horizons that let those businesses compound. That approach has worked through every cycle in market history. Stay disciplined, stay informed, and we will be right here with you every step of the way. I'm Chloe. That's all for this evening. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.